Chapter 3: Infrastructure of Digital Assets. Now it's time to step inside. Every building has walls, floors, rooms, and internal systems. Different ecosystems, infrastructure layers, projects, wallets, exchanges, and mechanisms that keep the digital world alive. Imagine a blockchain as a multi-story digital building. Its foundation is already in place. We've explored blockchain, cryptocurrencies, tokens, NFTs, and the key mechanisms behind how they work. But on top of this foundation, a much more complex structure is built, a fully developed ecosystem of digital assets. This ecosystem consists of multiple layers, each serving its own role. It includes base blockchain networks, scaling solutions, and cross-chain interoperability systems, as well as the everyday applications users interact with: wallets, exchanges, DeFi platforms, and NFT marketplaces. In this chapter, you will understand how this multi-layered structure works together to form the infrastructure of blockchain ecosystems, how the different layers interact with one another, and why this architecture is what enables the stability, scalability, and continuous growth of the digital economy. Part 1: Digital Infrastructure of the Ecosystem. Blockchain networks are required to operate in an environment without central authority or a single controlling entity. Because of this, the security requirements are extremely high. All functions within such a system are carried out by technical components, nodes, smart contracts, and consensus algorithms, which together ensure the decentralized nature of the network. At the same time, a blockchain must remain scalable. As the number of users, transactions, and data exchanges grows, network load continuously increases. If the system cannot adapt to this growth in time, it loses efficiency and practical value. This is precisely why a multi-layer blockchain architecture was created, to combine security, decentralization, and scalability within a single system. Each layer performs its own function, enhancing the overall performance of the network and enabling interaction between different blockchain ecosystems. This approach makes it possible to maintain a high level of security without sacrificing speed or usability. Now that we have established a basic understanding of the layered blockchain concept, it is time to take a closer look at each level in detail. For clarity, this architecture can be visualized as a sequence of layers, from foundational infrastructure to user-facing interfaces, each playing a distinct role in the ecosystem's operation. Step by step, we will explore their functionality and learn how to identify which layer different crypto projects belong to. Layer 0: Interoperability Infrastructure. For clarity, Layer 0 can be understood as a combination of two essential components, both of which are critical for the existence of any blockchain network. The hardware component forms the physical foundation of blockchains. This includes real-world devices that power the network: computers, servers, specialized mining machines such as ASIC miners, and distributed data centers. This infrastructure ensures the stability of large-scale networks and allows blockchain ecosystems to operate continuously. The technological component includes internet connectivity, communication protocols, cross-chain bridges, and messaging standards. This layer is responsible for the functionality and innovation of the blockchain environment. It enables different networks to integrate with one another while remaining compatible and interoperable. In the context of blockchain, it's important to understand that every network relies on physical infrastructure, a distributed system of servers, computers, or mining devices. At the same time, not all Layer 0 projects directly build this physical layer. Many operate at the level of software protocols and standards. Instead of running their own servers or mining farms, they develop technologies that allow different blockchains to securely connect, exchange data and assets, and function as a unified system. To better understand how Layer 0 works in practice, it's useful to move beyond theory and examine its functional capabilities. This layer serves both as a foundation for launching new blockchain networks and as an environment for their interaction. It provides tools that enable rapid deployment of new blockchains, seamless transfer of assets and data between networks, and the unification of separate ecosystems into a single interconnected space. However, these capabilities also come with challenges.
integrating multiple networks requires complex technical solutions, and cross-chain data exchange increases security demands. Additionally, the lack of unified standards often complicates long-term scalability across ecosystems. To summarize, Layer 0 forms the foundation for the development of full-scale blockchain ecosystems, either by providing the physical infrastructure that enables their existence, or by creating the tools that ensure interoperability and scalable growth across one or multiple interconnected networks.
Layer 1 – Base Blockchain Network. Layer 1 is a full-fledged platform that forms the foundation for building projects, DeFi applications, and higher layers of blockchain infrastructure. Projects at this level have their own independent blockchain network, a native cryptocurrency, and unique consensus and security mechanisms. They are responsible for processing transactions, executing smart contracts, creating tokens, and enabling applications that support the functionality of the entire ecosystem. Layer 1 networks are considered fundamental because they serve as the base for all subsequent layers and application-level services. They are responsible for the core properties of blockchain: security, decentralization, and network reliability. At the same time, it is important to distinguish between the base infrastructure and the applications built on top of it. For example, Uniswap operates within the Ethereum ecosystem, but it belongs to a higher layer as a DeFi application rather than the base network itself. The limitations of the base layer are best explained by the concept of the blockchain trilemma. It states that a network cannot simultaneously achieve maximum decentralization, high security, and scalability. As a result, most Layer 1 solutions prioritize security and decentralization, while scalability is often addressed at Layer 2. In essence, Layer 1 can be compared to the operating system of a blockchain ecosystem. It ensures the core functionality of the network, guarantees security and decentralization, and serves as the platform for scaling and further development across higher layers. This is the level that provides the foundation for building complex crypto projects, DeFi applications, and other services within the ecosystem. It also defines the consensus mechanism and transaction validation rules that determine how the network operates and maintains trust among participants. As a result, the performance, scalability, and limitations of Layer 1 directly influence the efficiency and user experience of all applications built on top of it. Layer 2 – Scaling Solutions. Layer 2 can be thought of as the second floor of our digital building. It consists of auxiliary projects and network technologies that operate on top of Layer 1 blockchains. Their primary goal is to offload the base network and make transactions faster and more cost-efficient without compromising the security and decentralization provided by Layer 1. The core principle behind Layer 2 is moving computation off the main blockchain. Most transactions are processed outside the Layer 1 network, within a specialized Layer 2 environment. After processing, only a compressed and verified result is submitted back to Layer 1, rather than every individual transaction. This approach significantly reduces the load on the base blockchain and increases overall network throughput. For users, this translates into faster transaction confirmations, lower fees, and a smoother experience when interacting with decentralized applications. For the broader ecosystem, Layer 2 is a critical scaling component that alleviates pressure on the base layer. As a result, blockchain networks become faster, more affordable, and capable of handling a much higher volume of transactions, laying the foundation for mass adoption and a growing user base. Layer 3 – Decentralized Applications. Layer 3 is built on top of Layer 2 solutions and represents the part of the blockchain ecosystem that users interact with directly. This is where decentralized applications, dApps, services, and user-facing interfaces come to life. Crypto wallets, DeFi platforms, NFT marketplaces, gaming applications, and other consumer-oriented solutions. The main purpose of Layer 3 is to make complex blockchain infrastructure simple, intuitive, and accessible. Users can send funds, swap tokens, or interact with services without needing to understand how consensus mechanisms work, where data is stored, or how blocks are produced. All technical processes are hidden under the hood, while interaction happens through familiar UI elements, such as buttons, menus, and straightforward user flows. Layer 3 is also responsible for user experience. It directly influences application responsiveness, interface usability, wallet security, and the overall perception of blockchain technology. If Layer 2 solves the scalability problem, Layer 3 addresses the challenge of mass adoption. In addition, Layer 3 plays a key role in cross-chain interaction. Through specialized protocols, applications can operate across multiple blockchain networks, exchange data, and execute transactions between different ecosystems. For users, this means being able to interact with multiple networks through a single interface without noticing their technical differences. It also enables composability between applications, allowing different services to integrate seamlessly and build on each other's functionality. Developers can create interconnected ecosystems where data and assets flow freely across platforms, increasing overall utility. This layer further supports personalization, enabling applications to adapt to user behavior and preferences in real time. Ultimately, Layer 3 is what transforms blockchain technology from a complex infrastructure into a practical and user-friendly digital experience. Below is a summary table outlining the key functions, advantages, challenges, and real-world examples of Layer 3. In conclusion, Layer 3 is the level where blockchain technology becomes understandable and practical for everyday users. It is where decentralized solutions begin to feel and function like familiar digital services, with additional benefits such as transparency, security, and the absence of centralized control. This layer bridges the gap between complex blockchain infrastructure and real-world usability. It provides interfaces and user experiences that significantly lower the entry barrier and allow interaction with blockchain systems without deep technical knowledge. As a result, Layer 3 becomes a key driver of mass adoption of decentralized technologies, turning blockchain from a niche innovation into a widely usable digital infrastructure. Layer 4. Application Services. This layer is best understood in a broader context of user interfaces and analytical tools that make blockchain activity visible and easy to interpret. These solutions transform complex underlying network processes into visual metrics, charts, and dashboards that can be analyzed without deep technical expertise. Through these tools, users can track transactions, analyze network activity, monitor capital flows, study participant behavior, and evaluate the overall health of an ecosystem. This creates a complete picture of how a blockchain actually operates and enables more informed decision-making based on real data, rather than assumptions or information noise. Layer 4 focuses on application services and analytics platforms that provide convenient, structured access to blockchain networks and crypto assets. At this level, users perceive blockchain not as a technical protocol, but as a set of practical tools for market analysis, risk assessment, and financial decision-making. For beginners, this is especially important, as Layer 4 allows interaction with the ecosystem without requiring an understanding of protocol architecture, node operation, or consensus mechanisms. In a broader sense, Layer 4 acts as a bridge between technology and users. It supports mass adoption of blockchain solutions by integrating them into everyday financial, investment, and analytical workflows. The rapid growth of decentralized services and the increasing demand for transparent data have driven the recognition of this layer as a distinct concept. From a technical standpoint, however, Layer 4 remains a sub-layer of Layer 3, extending and refining its functionality. Its core role is to make blockchain accessible to a wide audience, including users without any technical background. Through this layer, digital assets and blockchain technology move from a specialized field into a practical everyday tool for millions of people. Part 2. Ecosystem Components. We've already explored the multi-layered architecture of the blockchain ecosystem and reviewed examples of projects operating at each level, from foundational networks like Bitcoin and Ethereum to application layer solutions and interfaces at Layer 3 and 4. The next step is to understand how crypto projects are classified and what role each of them plays within this architecture. In this part of the chapter, we will focus on the main categories of crypto projects and analyze them in relation to their respective layers within the blockchain stack. This approach helps not only to identify the technological foundation of a project, but also to clearly understand the specific function it performs within the ecosystem. At the same time, we will touch on broader sectors such as DeFi,
DAO, DEX, RWA, and others that contribute to the multidimensional and comprehensive nature of the modern blockchain environment. When a user first encounters platforms like CryptoRank or similar analytics tools, they are often faced with an overwhelming amount of data and a wide variety of categories. To be honest, even experienced researchers can find it challenging to quickly navigate and locate relevant information about a specific project. This is where a foundational understanding of blockchain layers becomes essential. It simplifies navigation across this complex landscape of services. Moving forward, we will systematically rely on this framework, Layer 0, 1, 2, 3, and 4. On top of this structure, depending on a project's focus and specialization, we will determine its primary category. The main category reflects the core role of a project within the digital asset ecosystem, the specific need it fulfills. These categories include, but are not limited to, currency, chain, stablecoin, infrastructure, services, DeFi, GameFi, DPIN, NFT, RWA, social, and others. In addition, there are subcategories that describe the technological implementation or specialization of a project. These depend on the tools and approaches used in development, such as EVM, ZK, Node, smart contract, and similar frameworks. Subcategories provide a deeper understanding of a project's technical specificity and its competitive advantages within its primary category.
Category: Chain. The chain category is one of the most fundamental in the blockchain ecosystem, as it encompasses the core technologies on which the entire digital asset infrastructure is built. Projects in this category create the conditions for launching new blockchain networks, ensure their scalability, and establish the foundation for developing full-fledged ecosystems. This includes the entire technology stack, from network infrastructure to base protocols and scaling solutions. Within the chain category, several key subcategories can be identified, each corresponding to different layers of blockchain architecture. Layer 0. This subcategory includes projects that provide core network infrastructure and enable interaction between different blockchains. It is responsible for cross-chain communication, interoperability, and ecosystem synchronization. Layer 0 creates the conditions for separate networks to function as part of a unified environment. Examples: Polkadot, Cosmos, and Avalanche. Layer 1. This subcategory includes projects with their own independent blockchain. These networks form the base layer of the ecosystem, ensuring security, decentralization, and transaction processing. Depending on the consensus mechanism, they are classified as proof of work, proof of stake, or delegated proof of stake. Examples: Bitcoin, Ethereum, and Tron. Layer 2. This subcategory focuses on projects designed to improve the scalability and performance of Layer 1 networks. They process transactions off-chain, reducing network congestion and transaction fees. Depending on the scaling technology used, these solutions include rollups, ZK rollups, ZK proofs, and other approaches. Smart contract platform. This subcategory focuses on platforms designed for creating and executing smart contracts, self-executing code that enforces agreements without intermediaries. These platforms serve as the foundation for DeFi, NFTs, DAOs, and other decentralized services, offering different approaches to security, speed, and scalability. Examples: Ethereum, Solana, Cardano, and Near. Sidechain.
This subcategory includes independent blockchains that operate alongside a main network and have their own consensus mechanisms. Sidechains enable the transfer of assets between networks, reduce the load on the main blockchain, and allow experimentation with new features without risking the stability of the primary network. Examples: Polygon POS, Gnosis Chain, and Ronin. Together, these subcategories form the technological backbone of the blockchain ecosystem, enabling creation, scalability, and interoperability of modern digital asset networks. Examples: Optimism, Arbitrum, Polygon, ZK Sync, and Stacks. EVM, Ethereum Virtual Machine. This subcategory includes projects that provide compatibility with the Ethereum virtual machine. This allows developers to deploy smart contracts and decentralized applications originally built for Ethereum with little or no modification, simplifying migration and expanding the Ethereum ecosystem across multiple networks. Examples: BNB Chain, Avalanche C Chain, Polygon, and Phantom.
Category: Decentralized Finance. Decentralized finance, or DeFi, is one of the most dynamic and foundational sectors in the crypto ecosystem. It represents a fundamental redesign of financial infrastructure, where traditional services are rebuilt as open, programmable, and permissionless systems. Powered by blockchain technology, smart contracts, oracles, and decentralized governance, DeFi enables users to trade assets, earn yield, access liquidity, hedge risks, and transfer value globally without relying on banks or centralized intermediaries. At its core, DeFi replaces institutional trust with mathematical certainty and transparent code. Every transaction, rule, and financial mechanism is verifiable on-chain, creating a system that is not only open but also inherently auditable. A defining feature of DeFi is the absence of mandatory identity verification. In traditional finance, most operations require KYC, or Know Your Customer, which introduces friction and exclusion. While necessary for compliance, it limits access for millions. In DeFi, these barriers disappear. A wallet and an internet connection are enough to access global financial services. This has profound implications. According to the World Bank, nearly 2 billion adults remain unbanked. DeFi offers them a parallel financial system, one that is borderless, neutral, and inclusive. Another cornerstone of DeFi is DAO, Decentralized Autonomous Organizations. Governance is no longer centralized. Users collectively vote on protocol changes, treasury allocation, and long-term strategy. This transforms users into active participants and stakeholders rather than passive consumers. DeFi is not just replicating traditional finance, it is redefining it. It introduces programmable money, composable financial products, and continuous innovation without permission. DeFi is gradually forming a new financial reality where transparency and accessibility are core principles. Within this ecosystem, multiple subcategories have emerged, replicating traditional financial instruments in a decentralized environment.
Lending and borrowing. This sector recreates credit markets in a decentralized environment, allowing users to lend assets or borrow against collateral without intermediaries or credit checks. Loans are typically over-collateralized and executed automatically via smart contracts. For example, an ETH holder can use it as collateral to borrow stablecoins without selling their position, preserving exposure while unlocking liquidity. This mechanism allows capital to remain productive instead of idle, fundamentally changing how assets are utilized. Examples: Aave, Compound. Insurance. DeFi insurance enables users to protect assets against smart contract failures, hacks, and other risks inherent to decentralized systems. Insurance pools are funded by participants, while claims are processed through transparent mechanisms governed by smart contracts and community voting. This model replaces opaque insurance structures with open and verifiable systems, creating a native risk management layer where users collectively share and mitigate risks. Examples: Nexus Mutual, Insurace, and Sherlock. Decentralized exchanges, DEXs, allow users to trade assets directly from their wallets without relying on centralized platforms. Smart contracts automate transactions, while liquidity pools replace traditional order books. Liquidity providers earn fees, and traders gain uninterrupted access to global markets without restrictions. This model ensures that users maintain full custody of their assets, eliminating counterparty risk associated with centralized exchanges. Examples: Uniswap, Curve, Jupiter, and Aerodrome. Yield instruments. These tools allow users to generate passive income from crypto assets by deploying capital into yield-generating protocols. Key strategies include staking, locking tokens to secure the network and earn rewards; liquid staking, receiving derivative tokens, for example STETH, while maintaining liquidity; yield farming, providing liquidity to earn rewards and incentives. Examples: Yearn Finance, Convex, Lido, Rocket Pool, and Stater.
Restaking. Restaking introduces an advanced layer of capital utilization by allowing users to reuse already staked assets to secure additional protocols. This extends the role of capital beyond a single network. By enabling the same assets to contribute to multiple systems, restaking improves overall ecosystem security while simultaneously increasing user rewards. It represents a shift toward shared security models and more efficient allocation of resources. Examples: Eigenlayer. Derivatives. DeFi derivatives bring complex financial instruments on-chain, allowing users to hedge risk, speculate on price movements, and use leverage. Perpetual contracts, for example, enable traders to maintain leveraged positions without expiration, making them highly flexible tools for active market participants. This expands DeFi beyond simple transactions into a more sophisticated financial environment capable of supporting advanced strategies. Examples: Hyperliquid, Synthetics, DYDX, and GMX. Governance tokens. Governance tokens give users the ability to participate in protocol decision-making. Token holders can vote on upgrades, adjust parameters, and influence how funds are allocated. This shifts control from centralized entities to distributed communities, aligning incentives between users and developers while fostering long-term sustainability of protocols. Examples: Uniswap, Aave, MakerDAO, Sky, and Compound. Stable protocols. Stablecoins. Stablecoins provide price stability in an otherwise volatile crypto market. They are typically pegged to fiat currencies and serve as a reliable medium for transactions, lending, and liquidity provision. By reducing exposure to price fluctuations, stablecoins make DeFi usable for everyday financial operations and form the foundation for most on-chain economic activity. Types include fiat-backed, custodial, crypto-backed, decentralized, and algorithmic. Examples: MakerDAO, DAI, Frax, CurveDAO, and Liquidity. Crypto-basked tokens. These tokens are created by locking crypto assets in smart contracts and issuing a new token that represents the underlying value. This allows users to retain exposure to an asset
while using its tokenized version across DeFi protocols. Such tokens enable greater interoperability and composability, allowing assets to move seamlessly between platforms and participate in multiple strategies simultaneously. Examples include WBTC, wrapped Bitcoin, BTC usable in Ethereum DeFi, SETH, synthetic Ether, tracks ETH price without ownership, CRVUSD, stablecoin optimized for DeFi usage. DeFi forms a fully interconnected financial system where each component reinforces the others. Lending supports liquidity. Stablecoins enable transactions. DEXs power markets, and yield strategies optimize capital. Together, these elements create a system that is not only decentralized but also programmable, transparent, and globally accessible, reshaping how financial services are built, accessed, and experienced. The next evolution, DeFi 2.0. DeFi 2.0 represents the next generation of decentralized finance protocols, designed to address the structural limitations of early DeFi and build a more scalable, sustainable, and resilient financial ecosystem. This is not just a technological upgrade, it is a shift in paradigm. While DeFi 1.0 focused on open access, DeFi 2.0 emphasizes efficiency, sustainability, and long-term value creation. The new wave of protocols prioritizes more effective liquidity management, reduced reliance on speculative capital, and the creation of robust economic models that can sustain long-term growth. The core focus areas of DeFi 2.0: 1. Sustainable liquidity. Early DeFi relied heavily on liquidity mining, where users quickly moved capital between protocols in search of short-term rewards. DeFi 2.0 introduces models where protocols own or control their liquidity, reducing dependence on external providers and creating long-term stability. 2. Decentralization. New protocols aim to reduce reliance on centralized components, such as single-source oracles, fiat-backed stablecoins. Instead, they adopt more decentralized and resilient data and collateral systems. 3. DAO-driven governance. Governance becomes more deeply embedded into protocol design. DAOs evolve from simple voting mechanisms into core operational structures, managing treasury funds, incentive, and long-term strategy. 4. Institutional scalability. DeFi 2.0 moves toward predictable, structured systems that can support institutional participation and B2B use cases, making the ecosystem more attractive for large-scale capital. The core focus areas of DeFi 2.0: 1. Liquidity mining instability. In DeFi 1.0, users often sold reward tokens immediately, creating downward pressure and weakening protocols. DeFi 2.0 introduces bonding mechanisms, locked staking models, which encourage long-term participation and align incentives between users and protocols. 2. Inefficient liquidity. Liquidity was fragmented across platforms, reducing capital efficiency. In DeFi 2.0, LP tokens can be reused as collateral for loans or integrated into other protocols, significantly increasing capital efficiency. 3. Security risks. Early protocols were frequently exploited due to immature smart contract design. DeFi 2.0 incorporates smart contract audits, insurance mechanisms, and compensation systems for losses. This creates a more secure environment and increases user confidence. 4. Scalability and high fees. DeFi 1.0 was heavily dependent on Ethereum, leading to congestion and high transaction costs. DeFi 2.0 adopts Layer 2 solutions, multi-chain architectures, making transactions faster and more affordable. 5. Oracle centralization. Dependence on single Oracle providers created systemic risks. Modern protocols use multiple Oracle sources, data verification layers, to ensure reliability and reduce manipulation risks. Below are the key stages of the evolution of decentralized finance, illustrating shifts in approaches, protocol architecture, and economic models from DeFi 1.0 to DeFi 2.0. DeFi 2.0 unlocks new possibilities for efficient asset management. LP tokens can now be used as collateral for loans or integrated into other protocols, significantly increasing capital efficiency. Special attention is given to mitigating impermanent loss. Hedging mechanisms, including insurance funds and specialized internal tokens, help reduce risks for liquidity providers. Smart contract insurance adds another layer of protection, safeguarding funds against potential code vulnerabilities in a way that resembles traditional bank deposit insurance. Pioneers of DeFi 2.0 introduced fundamentally new approaches to liquidity and capital efficiency. One of the earliest examples is Olympus DAO, which pioneered an alternative to the classic liquidity model through a bond mechanism. Investors sell assets to the protocol's treasury in exchange for discounted tokens. This creates long-term incentives and reduces dependence on short-term rewards. Alchemix further evolved capital efficiency by enabling users to take loans backed by their future yield. If an asset generates income, for example through staking, a portion of that yield can be accessed upfront in the form of a loan. The Abracadabra protocol, Spell Token, pushed this concept even further by combining key DeFi 2.0 principles into a unified ecosystem. Users can leverage yield-bearing collateral, such as LP tokens or staked assets from other protocols like Yearn or Convex.
Category: Blockchain Infrastructure. This direction covers the full stack of technologies, protocols, and networks that ensure the stable operation, scalability, and interoperability of blockchain ecosystems. Projects in this category are rarely in the spotlight for end users, yet they form the technical backbone of the entire crypto industry. Unlike application layer services, infrastructure solutions do not always issue their own tokens or decentralized applications. Their primary mission is to provide other blockchains with a reliable, secure, and efficient foundation for growth. They simplify interoperability between different networks, ensure data availability and integrity, and create seamless conditions for both developers and end users. Thanks to this infrastructure layer, blockchain is no longer an isolated technology. It evolves into an interconnected, unified ecosystem. This category includes several core infrastructure domains that perform mission-critical functions: data transmission and storage, cross-chain communication, secure user connectivity, identity systems, and even physical world infrastructure. Collectively, these components ensure the integrity, scalability, and decentralization of the entire system. Each component plays its own role in supporting and advancing the digital infrastructure that makes everyday blockchain usage possible. Below, we briefly explore each of them to understand how the foundation of the modern crypto ecosystem is built. Data availability. Data availability ensures that all data required to verify transactions is accessible to every node in the network. This is especially critical for Layer 2 solutions, particularly rollups, where the correctness of computations cannot be verified without full and open access to underlying data. In this sense, data availability guarantees transparency, security, and trust in scalable blockchain systems. Examples: Celestia, EigenLayer, and Near Protocol. Cross-chain solutions. Cross-chain technologies enable interoperability between different blockchain networks. They allow assets and data to move across ecosystems, transforming blockchain from a fragmented environment into a connected one. With cross-chain solutions, users can interact with the same asset across multiple networks without dealing with the technical limitations of each individual blockchain. These approaches are essential for the growth of DeFi, multi-chain wallets, and interchain protocols. Examples: Cosmos IBC, Polkadot, Layer 0, and Axelar. Oracles. Oracles act as a bridge between blockchains and the real world. Since blockchain networks are closed systems with no native access to external data, oracles supply smart contracts with information such as prices, events, exchange rates, and API-based metrics. Without oracles, most DeFi protocols, derivatives platforms, and insurance applications simply would not function. They ensure accurate smart contract execution and extend blockchain capabilities far beyond internal network logic. Examples: Chainlink, Band Protocol, and Pyth. Bridges. Bridges are a core infrastructure element in multi-chain environments. They enable the transfer of assets and data between different blockchain networks, allowing ecosystems to interact without losing liquidity. This is often achieved through wrapped asset mechanisms, where a token from one blockchain is represented by an equivalent asset on another network. Bridges make capital flow freely across ecosystems and reduce market fragmentation. Examples: Wormhole, Multichain, and Stargate. Decentralized physical infrastructure, DePIN. DePIN represents a new stage in blockchain adoption by connecting digital systems with the physical world. This sector uses blockchain and token-based incentives to build and manage real-world infrastructure. It includes wireless networks, computing power, data storage, sensor systems, and energy solutions. The core idea is to incentivize users to deploy and maintain infrastructure through economic rewards. Over time, control and ownership shift from centralized corporations to decentralized communities. Leading DePIN projects include Helium, Filecoin, and Render Network. To address this, specialized cryptographic methods are used, most notably zero-knowledge proofs, which allow validation of information without revealing the underlying data. These technologies expand blockchain applications in finance, identity systems, and enterprise environments. Examples: Monero, Zcash, and Aztec Network. Decentralized identifiers, DID. DID introduce a new paradigm for digital identity in Web3. Unlike traditional systems where accounts are controlled by platforms, DID allows users to fully own and manage their identity. A DID is tied to the individual, not to a service, and can store verifiable data that only the owner controls. This significantly improves privacy, security, and autonomy in digital environments. Examples: World Network, Sign, and Artificial Superintelligence Alliance. Wallets. Wallets are the primary entry point into the blockchain ecosystem. A wallet stores cryptographic keys that provide access to on-chain assets, enables transaction signing, and allows interaction with decentralized applications. Different wallet types offer different trade-offs between convenience and security, making wallet selection a key part of any personal digital asset strategy. Examples: MetaMask, Ledger, Trezor, and Trust Wallet. Privacy.
Privacy remains a critical area of blockchain infrastructure, even despite the transparent nature of most networks. Many use cases require limiting exposure of sensitive data and transaction details.
Category: Blockchain Services. This segment brings together tools and services that operate on top of the core blockchain infrastructure, making it usable in everyday life. If infrastructure layers are responsible for network reliability and scalability, then services take on a different role. They simplify interaction with blockchain systems and lower the entry barrier for both individuals and businesses. These solutions help developers build decentralized applications faster without needing to dive deep into the underlying technical complexity of the network. For end users, they make Web3 more understandable, intuitive, and accessible, transforming a complex technology stack into something that can be used naturally. This category includes services for blockchain data access, developer tooling, and analytics platforms. Together, they form the application layer of the ecosystem, without which blockchain would remain a niche technology reserved for specialists. In the long run, this segment will largely determine the speed of blockchain integration into the real economy and everyday digital services. It acts as a bridge between complex technological foundations and end users, enabling mass adoption of Web3 solutions. Below, we explore the key subcategories of blockchain services and the role each of them plays in the evolution of Web3. Data API. Data services act as translators between blockchain systems and humans. They provide structured, readable access to on-chain data, freeing developers and analysts from working with raw blockchain information. Thanks to these solutions, building blockchain-based products becomes faster and significantly less technically complex. You get the right data at the right time, without needing to understand the internal mechanics of the network. Examples: the Graph, Alchemy, and Dune. An API, application programming interface, allows different software systems to communicate with each other. In the blockchain context, APIs enable applications to retrieve data and interact with network functions without directly engaging with the underlying infrastructure. This is one of the key mechanisms that makes blockchain accessible for mainstream adoption. Developer tools. Developer tools provide the working environment for building Web3 applications. They include frameworks and platforms that help developers write, test, and deploy smart contracts, connect to blockchain networks, and scale applications with unnecessary technical friction. These tools significantly shorten the path from idea to production-ready product, allowing developers to focus on logic and user experience rather than infrastructure complexity. Popular solutions in this category include Hardhat, Foundry, Remix IDE, Infura, ThirdWeb, and Alchemy SDK. Analytics. Analytics services transform blockchain into a powerful source of market intelligence. They enable real-time tracking of capital flows, wallet behavior, user activity, and project-level financial metrics. For investors, traders, and researchers, these tools are essential for understanding risk, market cycles, and the true underlying economy of blockchain ecosystems. Through analytics, blockchain transparency becomes a practical advantage rather than just a technical feature. Leading platforms in this segment include Arkham, Nansen, Token Terminal, and Masari. Category: Currency. This segment includes cryptocurrencies designed primarily as a medium of exchange and a store of value within blockchain ecosystems. These are digital equivalents of money that operate without the involvement of banks or government institutions, enabling direct peer-to-peer transactions on a global scale. The core value of these assets lies in their simplicity and reliability. Rather than focusing on complex functionality or expansive application ecosystems, they are built to fulfill the fundamental role of money in a digital environment. Thanks to decentralization and limited supply, many of these assets are widely perceived as a hedge against inflation and a tool for long-term value preservation. The most prominent example in this category is Bitcoin, which has become the benchmark for digital money and the foundation of the entire crypto market. Alongside it, projects like Litecoin and Dash continue to develop the concept of fast, accessible, and independent payment systems. At the same time, the effectiveness of these assets largely depends on liquidity levels and the degree of trust from users and the broader market. Category: Centralized Finance, CeFi. Centralized finance, CeFi, represents the centralized segment of the crypto industry, combining digital assets with a traditional financial management model. In CeFi, financial services are delivered through centralized platforms that act as intermediaries between users and the market, handling asset custody, transaction processing, and risk management. These platforms typically offer intuitive interfaces, fast execution, and customer support, making CeFi especially appealing to newcomers. Core services include centralized exchanges, custodial wallets, lending, staking, derivatives, and fiat on- and off-ramps that enable seamless entry into and exit from the crypto market. At the same time, CeFi requires trust in a third party. Users do not control their private keys and rely on the platform's security, operational integrity, and regulatory environment. For this reason, CeFi is often viewed as a transitional model between traditional finance and DeFi, blending the convenience of conventional financial services with access to digital assets.
Category: NFT. This sector brings together digital assets that are unique and non-fungible. In simple terms, an NFT can be thought of as a digital certificate that verifies ownership of a one-of-a-kind item on the internet. Just as an original painting or a collectible card derives its value from its uniqueness, NFTs serve the same purpose in the digital world. These tokens confirm authenticity and ownership of digital art, collectibles, in-game assets, music, virtual real estate, and other unique files. For owners, NFTs unlock a wide range of opportunities, from collecting and trading to content monetization and participation in gaming ecosystems and metaverses. At the same time, it's important to understand the key distinction between NFTs and traditional cryptocurrencies. Unlike fungible tokens, each NFT is unique and cannot be exchanged on a one-to-one basis. While Bitcoin or Ethereum are fungible, each unit holding the same value, every NFT is distinct and has no exact equivalent. This property forms the foundation of a new model of digital ownership. That said, the real value of NFTs is largely driven by demand, cultural relevance, and their utility within specific ecosystems. Within the NFT ecosystem, several distinct subcategories have emerged, each unlocking different aspects of non-fungible tokens and addressing the needs of creators, investors, and users. This flexibility allows NFTs to adapt to a wide range of use cases, from digital art to integration into financial and gaming products. NFT marketplaces. NFT marketplaces are digital platforms where non-fungible tokens are bought, sold, and traded. This is where market liquidity is formed and where the value of digital assets is discovered. The most widely known platform is OpenSea, which supports multiple blockchains and caters to a broad user base. Blur focuses on professional traders and high-frequency trading, while Magic Eden has become a key hub within the Solana ecosystem. Other platforms such as LooksRare and X2Y2 emphasize decentralization and lower fees, redistributing value back to the community. NFT finance. NFT finance bridges NFTs with decentralized finance, DeFi, mechanisms. In this segment, NFTs evolve from collectible items into financial instruments. Platforms like NFTFi and BendDAO allow users to take out loans using NFTs as collateral without selling them. JPEG expands this model by enabling the issuance of stablecoins backed by NFTs, while DropsDAO focuses on multi-chain liquidity. Together, these innovations form a new financial layer where digital uniqueness gains tangible economic value. NFT launchpads. NFT launchpads are platforms designed to help creators launch new NFT collections and support them at early stages. They assist with minting, audience building, and provide both technical and marketing infrastructure. Notable solutions include Zora, Manifold, and LaunchMyNFT. Meanwhile, Magic Eden Launchpad has become a major hub for launching collections on Solana and Ethereum, combining ease of use with access to a large community. NFT lending. Lending platforms focus on lending and renting NFTs as fully fledged financial assets. These services allow owners to unlock liquidity without relinquishing ownership, while lenders earn yield through interest. Platforms such as Arcade.xyz, NFTFi, and Astaria are building bridges between the NFT market and DeFi lending, gradually transforming NFTs into instruments for long-term financial utility. Imagine a world where the boundaries between physical and digital reality gradually disappear. It's a space where you can own virtual land, build digital businesses, attend concerts, connect with people from the globe, compete in events, and even earn income without leaving your home. If you're familiar with the film Ready Player One, you already have an intuitive sense of a global virtual universe where people live parallel digital lives. However, the Web3 Metaverse is not just science fiction, it's an emerging technological frontier already taking shape through blockchain, NFTs, and community-driven platforms. Its defining feature is true ownership. Users don't just interact with digital objects, they actually own them. From virtual land and avatars to in-game items and unique identities. This ownership is secured through NFTs, which serve as verifiable proof of digital asset ownership. The metaverse naturally extends the philosophy of Web3, where control and value shift from centralized platforms to users. That's why this category isn't just a single product or technology, it's an ecosystem composed of several interconnected subcategories. Each plays a distinct role in building a cohesive digital universe. Gaming Metaverse. The gaming metaverse focuses on gamified experiences where gaming goes far beyond entertainment. Users don't just play, they create content, own in-game assets, and monetize their participation. In this environment, gaming evolves into a full-fledged economic system where time, skill, and engagement carry real-world value. Examples are Gala games, Immutable, and Big Time. Virtual worlds are metaverse platforms with their own digital infrastructure where users can own land, build environments, host events, and interact with others. These platforms create a new type of social digital space where ownership and creativity merge with communication. Examples are Decentraland and the Sandbox. VR/AR Metaverse. The VR/AR Metaverse combines blockchain with virtual reality and augmented reality technologies to bring digital experiences closer to physical presence. These projects explore new levels of immersion where the line between real and virtual becomes increasingly blurred. Examples are Victoria VR, OVR, Somnium Space Cubes, and Wilder World.
Category: GameFi. GameFi represents a new paradigm in blockchain gaming, one where users don't just play but actually own the outcomes of their activity and earn financial rewards for participation. This is not a passing trend, but a fundamental shift in the relationship between players and digital environments. In traditional games, the economy is fully controlled by the developer. Items, characters, and achievements remain locked within a closed system with no real exit for the player. GameFi changes this model entirely. Here, the economy belongs to the users themselves, who collectively shape and evolve the game world. Players earn tokens or NFTs based on skill, progress, and achievements. These can include virtual land, characters, weapons, artifacts, or rare items. All of these assets exist as NFTs, are stored on-chain, and carry real market value. They can be freely traded, exchanged, or used across different parts of the ecosystem. Play-to-earn and play-to-own mechanics allow players not just to spend money, but to invest time and effort with the expectation of long-term value. Under the hood, this model is powered by a full stack of technologies:
NFTs establish ownership, tokens drive in-game economies, smart contracts automate rules and interactions, and DeFi mechanisms add financial flexibility, from staking to lending and liquidity. Play to earn, P2E. Play to earn is a model where players receive tokens or NFTs simply for participating in gameplay. Character progression, battle victories, quest completion, and tournament participation all become economically valuable activities. In this model, the player is no longer a passive user. They become an active participant in the game economy. Notable examples include Axie Infinity and Thetan Arena. Gaming utility tokens. Gaming utility tokens are in-game tokens that power day-to-day functionality. They are used for purchasing items, upgrades, participating in activities, or building in-game assets. These tokens are focused on utility rather than governance. Strong examples include ecosystems like the Sandbox and Pixels. Gaming governance tokens. Gaming governance tokens give players a voice in the development of the project. Token holders can vote on game updates, rule changes, feature releases, and asset issuance, bringing users closer to co-ownership of the platform. Well-known examples include AXS within the Axie Infinity ecosystem and Gala in Gala games. Role-playing games, RPGs. Simulation games replicate economic, social, or environmental systems. Players build cities, farms, or even worlds via blockchain. These are simulations where ownership carries real value and can exist beyond a single game. Leading projects include My Neighbor Alice and Wilder World.
Simulation games. Simulation games replicate economic, social, or environmental systems. Players build cities, farms, or entire virtual worlds, owning every element via blockchain. These are simulations where ownership carries real value and can exist beyond a single game. Leading projects include My Neighbor Alice and Wilder World. Gaming platforms. Gaming platforms are infrastructure ecosystems that provide tools for developing, launching, and scaling blockchain games. They bring together developers, players, and investors into a unified environment, accelerating the growth of Web3 gaming. Key platforms include Gala Games, Immutable X, Engine, and Beam. Gaming marketplaces. Gaming marketplaces are platforms for trading in-game assets. Users can buy and sell characters, land, items, or tokens while maintaining full ownership. Unlike traditional gaming marketplaces, these assets can circulate freely on open markets. Leading platforms include Fractal, Tofu NFT, and GameStop NFT. Card games. Card games are built around collectible cards where each card exists as an individual NFT. Players build decks, develop strategies, and compete, owning their cards just like physical collectibles. Popular examples include Gods Unchained and Skyweaver. Category: SocialFi. A category shaped by next-generation social networks where human interaction is combined with the economic incentives of Web3. Imagine Facebook or YouTube, where your posts and videos become fully-fledged digital assets. Your profile doubles as a crypto wallet, and every interaction within the community carries financial value. That's the model SocialFi introduces, a fusion of social platforms and decentralized financial mechanisms. In this environment, the user is no longer the product of the platform. Instead, they own their content, control their audience, and directly benefit from their activity. Likes, comments, subscriptions, and reputation evolve into components of an economy, not just metrics for advertising algorithms. SocialFi also addresses one of the biggest issues of traditional social networks, centralized monetization. Where corporations once captured the majority of profits, Web3 social platforms distribute economic value among content creators, active community participants, and even readers. This creates a more equitable model where every contribution matters. Depending on whether a platform focuses more on content or on social interaction, SocialFi can be divided into two primary segments. Social media, platforms centered on creating, publishing, and distributing content. Within SocialFi, these services enable creators to directly monetize their posts, videos, or images without relying on advertising intermediaries. Data is typically stored on a blockchain or in decentralized storage solutions like IPFS, and content itself can be tokenized to represent ownership rights. Notable examples include Minds, a decentralized alternative to Facebook that rewards user engagement; Decode, a Web3 version of YouTube with content hosted on IPFS; and Mirror, a platform for tokenized blogging often compared to a Web3 native version of Medium. Social networks, platforms focused less on content and more on building social connections between users. Subscriptions, likes, interactions, and reputation are recorded in smart contracts, while user profiles often exist as NFTs owned by the users themselves. This approach allows the social graph to exist independently of any single application and to be seamlessly ported across platforms. Leading examples in this space include Lens Protocol, where users fully control their profiles and social connections; Farcaster, an open social protocol that enables migration between applications; and CyberConnect, an infrastructure for building decentralized social graphs. Ultimately, SocialFi transforms social platforms from content consumption tools into fully fledged economic ecosystems where value is created and distributed by the community itself.
Category: Real-world assets. The newest category to emerge in the current cycle encompasses assets that exist outside the digital realm but can be integrated into the blockchain ecosystem. This includes both tangible assets, real estate, transportation, precious metals. Through tokenization, these assets gain a second life within decentralized financial systems. Tokenization converts a real-world asset into digital units, each representing a fraction of its value. Imagine real estate divided not among a handful of investors, but into hundreds or even thousands of tokens. This dramatically lowers the barrier to entry, opening previously inaccessible markets to a much broader audience. You no longer need full ownership of an asset to participate in its economic value. Beyond accessibility, tokenized assets unlock a new level of liquidity. Digital tokens can be easily transferred, traded, or used as collateral, while all transactions are recorded on the blockchain, enhancing transparency and reducing the risk of manipulation. Smart contracts automate asset management, streamline execution, and minimize reliance on human intermediaries. Geographical boundaries fade away, making access to assets truly global. This structure illustrates how RWA integrates traditional asset classes into blockchain-based financial systems, unlocking liquidity, accessibility, and global participation at scale. In this sense, RWA is not just another asset class within the crypto economy. It is a bridge between traditional finance and decentralized technologies. Through this bridge, capital moves faster, more transparently, and more efficiently, laying the foundation for the next phase of the global digital economy.
At the same time, the development of this sector is closely tied to regulatory frameworks, as integrating real-world assets requires legal clarity and strong property rights protection. Equally important is the quality of asset digitization and the integrity of the underlying data. Successful RWA implementations open the door to new financial instruments that combine the stability of traditional assets with the flexibility of blockchain technology. Ultimately, this segment has the potential to significantly reshape global capital markets. Within DeFi, several RWA subcategories have already emerged, reflecting different types of tokenized real-world assets integrated into decentralized lending, investment, and liquidity management protocols. This enables traditional assets to serve as the foundation for new financial instruments and strategies. As a result, investment opportunities become accessible to a much wider range of participants, from institutional players to retail investors, marking one of the key transformations of the modern financial system. Let's explore the primary asset classes you can use to diversify your portfolio. U.S. Treasuries. Short and long-term debt instruments issued by the U.S. government are widely considered among the safest investments in the world. For example, Ondo Finance allows users to gain exposure to short-term treasury bonds through the USDY token, while Securitize provides access to T-bills in a digital asset format for both retail and institutional investors. The key takeaway, stability and reliability can be combined with technology to make investing more accessible. Global bonds. Bonds issued by governments or corporations outside the United States, including EU sovereign debt and corporate securities. Backed finance offers tokens such as BC3 and BHI, representing Eurobonds and high-yield corporate bonds. These examples show how global diversification can expand your investment horizon, even with relatively small initial capital. Private credit. Loans issued directly by private companies without traditional banking intermediaries. In DeFi, this takes the form of decentralized business lending. Key platforms include MakerDAO, Figure, Maple Finance, Goldfinch, and Centrifuge. These protocols allow investors to fund real-world businesses, tokenize assets, and earn yield without relying on traditional financial institutions. Commodities. Physical goods such as gold, oil, or agricultural products that can be tokenized and traded on-chain. Paxos offers PAXG, where each token is backed by 1 physical ounce of gold, while Tether Gold XAUT gives holders rights to a corresponding amount of the metal. By investing in tokenized commodities, you can hedge against inflation and market volatility without the burden of physical storage. Institutional funds. Financial products typically managed by large funds or banks. In DeFi, these appear as tokenized funds and derivatives. Ondo Finance and Backed Finance provide exposure to ETFs and publicly traded assets, making institutional-grade strategies accessible to individual investors. Tokenized stocks. Shares of publicly traded companies represented in digital form. Backed Finance X Stocks offers tokenized exposure to major companies such as Apple X Stock, Nvidia X Stock, and Nasdaq X Stock, allowing investors to participate in market growth without purchasing traditional equities through brokerage accounts. Tokenized real estate. Fractional ownership of physical properties, including residential, commercial, and industrial real estate. Realty enables users to purchase shares in U.S. properties and earn rental income in crypto. Propy streamlines real estate transactions via blockchain, and Landshare opens access to income-generating properties for DeFi users. The key insight: you can now invest in global real estate markets without owning an entire property. Land ownership. Tokenization of land enables fractional ownership of both physical and digital plots, collective investment, and the use of land as collateral in DeFi. Platforms such as Parcel and Myco provide access to land-based and ecological assets through tokenized models. This sector highlights how the future of investing extends beyond traditional assets to include land as both a resource and an opportunity
In the world
for
of
collective ownership.
cryptocurrencies, some projects begin as jokes, only to evolve into large-scale social and investment phenomena. This is exactly how meme tokens came to life, assets that have reshaped how we think about value, community, and the role of emotions in digital markets. The first and most iconic example is Dogecoin, created in 2013 as a parody of Bitcoin. Its Shiba Inu dog mascot quickly became a recognizable internet meme, and an active community formed around the project. Dogecoin was widely used for online tipping and charitable initiatives, and later gained global attention thanks in part to public support from Elon Musk. It proved that even a light-hearted project can have real-world impact. Over time, other major meme tokens emerged, including Shiba Inu, Pepe, and Floki. Each built large and highly engaged online communities. Their success highlights a key insight. Emotional connection and virality can sometimes outweigh pure technology. Meme tokens are cryptocurrencies inspired by memes, jokes, or pop culture. Unlike traditional blockchain projects, they often lack complex technical infrastructure or clearly defined economic models. Their value is driven primarily by social media momentum, community engagement, and hype cycles. In many ways, these assets are powered more by culture and narrative than by code. The primary driving force behind meme tokens is the community. It can rapidly amplify price movements, create trends, and capture market attention. At the same time, this dynamic makes meme tokens extremely volatile. Prices can surge dramatically in a short period and fall just as quickly. Most meme tokens are short-lived, and only a few evolve into lasting cultural symbols. For newcomers, it's important to understand that meme tokens are high-risk assets. They function more as speculative experiments or forms of participation in internet culture than as long-term investment vehicles. Any capital allocation should be approached cautiously, using only funds you can afford to lose. Ultimately, meme tokens represent a unique intersection of humor, community, and finance, clearly illustrating how emotions and social narratives can shape markets in the Web3 era. As of today, this segment stands out as one of the most dynamic and promising within the Web3 landscape. It brings together two defining ideas of our time: decentralization and intelligent automation. At this intersection, a new class of protocols is emerging, capable of transforming how we approach data analysis, ecosystem management, and interaction with digital environments. Within this domain, several key subcategories are gradually taking shape. AI crypto projects, platforms and infrastructure solutions that combine machine learning algorithms with blockchain technology. AI agents, autonomous or semi-autonomous digital entities capable of executing tasks in decentralized environments without constant human intervention. These agents can analyze markets, interact with smart contracts, manage assets, or act as personal assistants within Web3. They learn from data,
adapt to changing conditions, and operate based on predefined rules or economic incentives. Over time, AI agents evolve into fully fledged participants in decentralized economies operating alongside humans. AI agent platforms, environments where such agents can be developed, deployed, coordinated, and monetized. They enable the creation of entire ecosystems of autonomous agents that can collaborate or compete with one another. Examples include Autonolas and Fetch.ai, where agents are capable of executing complex, decentralized tasks in real time. AI frameworks, infrastructure solutions for building, training, and deploying AI models in decentralized environments. They address the critical issue of centralized data control by enabling secure data sharing and collaborative model training. They lay the foundation for an open data economy where value is distributed among all participants. Ocean Protocol is a strong example of this approach, combining data infrastructure with economic incentives for data usage.
Part 3. Decentralized governance model. In the traditional world, corporate governance is built on hierarchy. Shareholders exert influence through a board of directors. Decisions flow down to management, and then to employees. This model is well established, but in Web3, it is gradually losing its monopoly. In a decentralized environment, a different logic is emerging. Decentralized autonomous organizations, or DAOs, introduce a model where decisions are made by the community, and the rules of interaction are embedded directly into code and algorithms. Smart contracts replace bureaucracy, and transparency becomes a baseline requirement rather than an exception. It is important to understand that decentralized governance is not an end in itself. It is a tool that enables Web3 projects, funds, ecosystems, and shared resources to be managed without centralized control. Anyone holding tokens gains the right to influence the future direction of the project. Digital organizations in Web3 function as a kind of operating system for protocols. They are responsible for strategic direction, resource allocation, accountability, code upgrades, and integration with other ecosystems. In essence, they transform collective community intent into concrete actions, not just declarations, but executable outcomes.
Governance structure in DAOs. The governance process in decentralized autonomous organizations, DAOs, typically unfolds in several stages. First, a community member initiates a proposal. This may involve changing protocol parameters, approving a budget, or introducing a new strategic idea. The proposal then moves into a public discussion phase across forums, Discord channels, or specialized governance platforms. After discussion comes the voting stage. The most common model is simple. One token equals one vote, although delegation mechanisms and alternative voting systems are increasingly being adopted. If the proposal receives sufficient community support, it moves to the execution phase. In many cases, execution is fully automated through smart contracts. In others, it is carried out by trusted operational structures such as multi-sig wallets. This approach creates a universal model of decentralized governance that different communities can adapt to their own needs. The flexibility of this mechanism has led to the emergence of several primary types of DAOs, each applying shared governance principles within its own context. 1. Investment DAOs. Early collective investment platforms where participants pool capital and jointly decide on investments in startups, NFTs, or digital assets. Examples: the Lao, Flamingo DAO. 2. Protocol DAOs. Platforms focused on managing the technical and economic parameters of DeFi protocols, including fees, smart contract upgrades, and overall ecosystem strategy. Examples: Uniswap, Aave. 3. Service DAOs. communities of specialists across different fields who collaborate on client work and projects, enabling decentralized coordination and reward distribution. Examples: Raid Guild, DZ-DAO. 4. Grant DAOs. Entities responsible for funding open-source initiatives, startups, and research projects through collective allocation of community resources. Examples: Gitcoin, MulchDAO. 5. Meme culture DAOs. Communities formed around internet culture, memes, and ideas, combining social interaction with collective financial action. Examples: Constitution DAO, Nouns DAO. 6. Art DAOs. Organizations focused on collective management of art funds, NFT collections, and cultural programs, enabling new models of creative support. Ultimately, DAOs are not a universal template. They are a flexible organizational tool that can be adapted to finance, technology, culture, or art, while preserving a core principle: collective, transparent governance without centralized control.
Evolution of DAO 2.0. The decentralized governance model is constantly evolving. As Web3 projects grow in scale and complexity, DAOs are gradually transitioning from experimental structures to more mature and structured forms. A key development has been voting delegation, which allows community members to assign their voting power to active representatives. This improves decision quality and reduces passive participation. Another major direction is modular governance, where an organization is split into specialized subunits responsible for areas such as finance, development, communications, or security. This makes governance more flexible and efficient. A third element is decision automation, which takes into account not only token holdings, but also the actual contribution of participants. This shifts governance power toward activity and impact rather than purely capital-based influence. In addition, hybrid governance models are becoming increasingly important, combining elements of decentralized voting with centralized coordination. These approaches enable faster execution of critical decisions while preserving transparency and community involvement. At the same time, the evolution of DAOs comes with challenges, including coordination costs, difficulty in reaching consensus, and risks of low participation. These issues continuously push projects to refine governance mechanisms and improve incentive structures. Together, these developments reflect the maturation and strengthening of the ecosystem, where decentralization is increasingly balanced with efficiency and accountability.
Part 4. Ethereum Ecosystem. In the world of digital assets, Ethereum holds a truly unique position. It is not just the second largest cryptocurrency by market capitalization after Bitcoin. Ethereum is a full-fledged technological platform that has become the foundation for most key innovations in the Web3 space. Its influence on the development of the crypto industry has long gone far beyond the traditional understanding of blockchain. Ethereum is an environment where new approaches to digital ownership, finance, community governance, and the internet as a whole are being formed. Thanks to smart contract functionality that executes without intermediaries, the platform opened the door to a new era of the internet. This era is built on decentralization, openness, and community-driven control rather than centralized institutions. At the same time, Ethereum sets the standards for decentralized application development and forms the infrastructure on which a significant portion of today's crypto economy is built. Its role is gradually evolving from an innovative platform into a foundational layer of the global digital financial system. It is on Ethereum that key sectors have emerged, such as decentralized finance, DeFi, financial services without banks, non-fungible tokens, NFTs, digital art and collectibles, blockchain gaming, ownership and earning models within game worlds, real-world asset tokenization, RWA, bringing real assets into digital form. Together, these sectors form a multi-dimensional ecosystem where technology intersects with economics and social interaction. The Ethereum ecosystem is not limited to its main network. A significant portion of activity has migrated to Layer 2 scaling solutions, such as Optimism, Base, Arbitrum, and others. These solutions reduce transaction fees, increase throughput, and make decentralized applications more accessible to a broader user base. Although they are all unified under the Ethereum brand, the ecosystem itself remains diverse and highly heterogeneous. Within the network, there are thousands of tokens serving different functions. Governance tokens grant voting rights in decentralized autonomous organizations. Utility tokens provide access to services and protocols, and assets linked to real-world value act as digital equivalents of traditional financial instruments. They differ not only in purpose, but also in economic models, volatility, issuance mechanisms, and use cases. At the same time, the vast majority of tokens circulating on Ethereum-based decentralized exchanges follow the ERC20 standard, the network's native format that ensures interoperability and composability across protocols.
Collectively, the Ethereum ecosystem spans dozens of sectors and thousands of assets, each playing its own role within the digital environment. A powerful network effect driven by global access to users and developers, combined with deep liquidity, creates a synergy that continuously accelerates platform growth and drives ongoing innovation. In this chapter, we will focus on the most important sectors and the most influential assets representing the key segments of the Ethereum ecosystem. From flagship DeFi protocols and Layer 2 scaling solutions to critical infrastructure projects, this overview will help you see Ethereum as a living, dynamic, and deeply interconnected network that forms the backbone of modern Web3.
Ethereum Stack Base Layer. The Ethereum ecosystem is built on a modular architecture and is generally viewed as a technological stack, where each layer is responsible for a specific function within the network. This approach allows Ethereum to remain simultaneously secure, decentralized, and open to scaling. Layer 1, or L1, is the foundational layer of the network and its technical core. This is where the unified state of the blockchain is maintained, transactions are validated, and smart contracts, the backbone of the entire ecosystem, are executed. Ethereum's security is ensured by a decentralized proof-of-stake consensus mechanism, in which thousands of validators from around the world participate. This layer defines the network's operating rules, stores data, guarantees the immutability of transaction history, and serves as the foundation for all dApps, ERC standard tokens, and protocols operating within the Ethereum ecosystem. The reliability of Layer 1 enables the development of large-scale financial and application layer solutions without compromising trust in the network. Core components of Layer 1. Ethereum Mainnet. The main Ethereum network, where all operations carry real economic value. This is where actual transactions are executed, tokens are exchanged, decentralized applications run, and user assets are stored. Unlike test networks, the mainnet is not designed for experimentation. Every action has financial consequences, making network security and stability critically important. Ethereum Virtual Machine, EVM. The Ethereum Virtual Machine acts as a global decentralized computer. It ensures that smart contracts execute consistently across all network nodes, regardless of their physical location. Thanks to the EVM, every smart contract runs in a predictable and deterministic way, which is a core requirement for trust in a decentralized environment. Smart contracts. software algorithms that automatically execute agreement conditions based on an if this, then that logic, without intermediaries. Their use cases span a wide range of applications: token transfers, NFT launches, DAO governance voting, and DeFi operations including lending, trading, staking, and liquidity management. Smart contracts are what transformed Ethereum from a simple blockchain network into a universal platform for building decentralized economic systems.
Ethereum Stack, Scaling Layer. Layer 2, L2, solutions are scaling technologies built on top of the Ethereum main blockchain. Their purpose is to offload computation and transaction processing away from Layer 1. As a result, users benefit from significantly lower fees and higher transaction speeds, while still inheriting the security and finality guaranteed by the Ethereum network. The core role of Layer 2 is scaling without compromise. While the base layer focuses on security and decentralization, the second layer is responsible for throughput and economic efficiency. This architecture allows Ethereum to support thousands of decentralized applications while remaining an open platform for mass adoption. Ethereum is often compared to global financial infrastructure due to its reliability and security. However, under heavy usage, the base layer cannot always process transactions quickly or cheaply. This is precisely why Layer 2 solutions exist. They operate on top of Ethereum, absorbing part of the network load without undermining its foundational security guarantees. Core components of Layer 2. Rollups. Most Layer 2 solutions are based on the rollup approach. Many transactions are processed off-chain, and only a compressed summary, along with a validity proof, is submitted back to Ethereum. This significantly reduces transaction costs and increases throughput while maintaining trust in the base layer.
A practical implementation of rollup technology is Base, a network built on the optimistic rollup model. In this system, transactions are assumed to be valid by default unless proven otherwise. If fraud is suspected, the system allows verification and correction of the state. Base combines low fees, high speed, and full compatibility with the Ethereum ecosystem, making it suitable for mass adoption. Validiums. Another scaling approach is Validiums. Like rollups, they use cryptographic proofs to verify computation correctness, but store transaction data off-chain instead of on Ethereum. This further reduces costs and increases scalability, though it introduces a trade-off in decentralization, as data availability depends on external infrastructure. Volitions. A flexible hybrid model that allows users to choose where data is stored. For high-security operations, data remains on-chain within Ethereum, ensuring maximum trust and protection. For less sensitive operations, data can be stored off-chain, reducing costs and increasing speed. This approach enables a dynamic balance between security and scalability, depending on the specific use case. Thanks to these solutions, Ethereum is gradually evolving from a network with limited throughput into a universal platform capable of serving millions of users. Layer 2 makes large-scale adoption of decentralized applications possible while preserving the core principles of security, openness, and decentralization that define the entire ecosystem. This approach significantly reduces transaction costs and improves processing speed, making everyday blockchain interactions more practical for users and developers. It also enables the ecosystem to scale without compromising the integrity of the base layer, ensuring long-term sustainability and resilience. As a result, Ethereum can support increasingly complex applications while maintaining a strong foundation of trust and decentralization.
Ethereum Stack, Application Layer, dApps. Layer 3 Ethereum represents the application layer of the stack and effectively serves as the face of Web3. This is where users first interact directly with blockchain technology in their everyday digital experience. At this level, decentralized applications, dApps,
operate, enabling users to engage with finance, digital assets, gaming, and communities, without needing to understand the underlying technical complexity of the network architecture. Layer 3 leverages the security of Ethereum's base layer, Layer 1, and the scalability and speed of Layer 2 solutions, combining these capabilities into seamless, user-friendly services. As a result, blockchain ceases to be an abstract concept and becomes a practical tool that can be used intuitively and comfortably. Here, Web3 is no longer theory. It becomes a real, user-facing internet of the next generation. The primary role of this layer is to deliver end-user services with high usability, low fees, and specialized functionality. Layer 3 is the most application-rich segment of the stack, as it is where technology takes concrete form in financial protocols, digital marketplaces, gaming environments, and social platforms. Within this layer, we find decentralized financial services, DAOs, NFT projects, gaming and virtual worlds, and access interfaces such as crypto wallets and decentralized exchanges. A critical role is also played by user experience solutions, including onboarding tools, digital identity management, and simplified interaction layers for complex protocols. Collectively, these components form a living and dynamic ecosystem that enables new models of finance, digital ownership, and social interaction on the internet. The diversity of tools and services is what transforms Ethereum from a simple blockchain into a full-fledged innovation platform. After reviewing the full stack, it becomes clear that Ethereum's true strength lies in its application layer. This is where technology meets real user needs and forms the foundation of a new digital space. In the next section, we will explore these components in more detail to understand how they interact and create a unified ecosystem.
Ethereum Stack. Infrastructure. Infrastructure within the Ethereum ecosystem plays a critical role in ensuring the stability, security, and accessibility of the network across all layers, from the base blockchain to end-user applications. It can be thought of as the invisible backbone that connects all system components and ensures their seamless coordination. Thanks to infrastructure solutions, decentralized applications, dApps, DeFi protocols, and NFT platforms are able to send transactions, retrieve blockchain data, and respond to network events in real time. For example, services such as Infura or Alchemy allow developers to connect to the Ethereum network without running their own nodes, significantly simplifying product development and scaling. Layer 2 solutions, particularly rollups, are tightly integrated with Ethereum's infrastructure. They interact with Layer 1 for data submission, transaction verification, and asset settlement, while still inheriting the security of the base network. Additional layers of infrastructure include monitoring, security, and backup systems that ensure continuous application uptime even under complex or high-risk conditions. Understanding this layer provides a deeper view of how the Ethereum ecosystem actually operates.
Below are the core infrastructure components that power the network. Oracles. Oracles play a critical role in Ethereum by connecting the blockchain to the external world. Since smart contracts cannot directly access off-chain data, oracles provide information such as market prices, exchange rates, event outcomes, and other external inputs. The most well-known example is Chainlink, which uses a decentralized network of nodes to deliver verified data to smart contracts. This makes it a foundational component of most DeFi protocols in the Ethereum ecosystem. RPC and Node. RPC and node providers serve as the primary access points to the network for users and developers. They allow wallets, dApps, and services to interact with Ethereum, send transactions, and read blockchain state without requiring users to run their own infrastructure. Providers such as Infura and Alchemy offer stable APIs and development tools for testing, deployment, and scaling applications, significantly lowering the technical barrier to entry. Storage. Ethereum is optimized for executing logic and storing financial data, but it is not designed for large-scale data storage. This is why decentralized storage solutions such as IPFS and Arweave have become essential parts of the ecosystem. IPFS enables distributed file access via content hashing, while Arweave provides permanent on-chain data storage. These systems are widely used in NFT projects, where the token exists on Ethereum, but metadata is stored off-chain.
Bridges. Cross-chain interoperability solutions enable communication between Ethereum and other blockchains, allowing assets and data to move across networks. Solutions such as Wormhole and Synapse support a multi-chain ecosystem by enabling wrapped assets and expanding liquidity beyond a single chain. Bridges are a key enabler of multi-chain DeFi and universal Web3 application. SDK to developer tools. Developer tools form the technical foundation of Ethereum. Frameworks such as Hardhat, Truffle, and Ethers.js simplify writing, testing, and deploying smart contracts, while OpenZeppelin libraries provide secure and audited contract templates. These tools reduce development risk and make the ecosystem accessible to both beginners and advanced teams. Data to indexing. Efficient application performance requires fast access to historical on-chain data. The graph solves this by indexing Ethereum data and exposing it through structured APIs. This enables analytics dashboards and user interfaces without the need to process raw blockchain data directly. Digital identity and authentication. Digital identity projects simplify interaction within the Ethereum ecosystem. Ethereum Name Service replaces complex wallet addresses with human-readable names, while solutions like Sign-in with Ethereum enable authentication without centralized intermediaries. This forms the foundation of decentralized identity and improves trust between users and services. DAO tooling. DAO tools enable collective governance of protocols, funds, and communities. Snapshot enables gas-free voting. Aragon provides DAO management frameworks, and Tally offers governance analytics and tracking. Together, these tools transform community intent into real governance actions within the Ethereum ecosystem.
Ethereum Stack, decentralized finance. Ethereum is the undisputed center of gravity in the decentralized finance sector. It is within its ecosystem that key next-generation financial protocols such as Uniswap, Aave, and MakerDAO first emerged and achieved mass adoption. On top of Ethereum, a fully functional financial infrastructure has formed, one that allows users to take out loans without banks, exchange assets without centralized exchanges, earn yield on liquidity without traditional intermediaries, and invest directly in digital projects. As of 2025, Ethereum maintains its leadership in the DeFi sector, accounting for more than 60% of total value locked across the market. The aggregate capital deployed in Ethereum-based DeFi protocols exceeds $40 billion, with the highest concentration in liquid staking, lending, and decentralized trading. Protocols such as Lido, Aave, and Uniswap form the core of this economic activity. The transition of Ethereum to proof-of-stake, combined with the rapid development of Layer 2 solutions such as Arbitrum and Optimism, has significantly expanded real-world DeFi usage. The network has become more accessible for both developers and users by reducing transaction costs and increasing interaction speed with protocols.
The DeFi ecosystem on Ethereum continues to evolve. Alongside foundational financial services, new primitives are emerging: decentralized derivatives, tokenized real-world assets, and automated capital management strategies. This is paving the way for deeper integration with traditional finance. At the same time, the community remains the primary driving force. Millions of users interact with protocols through intuitive interfaces, while the number of developers continues to grow steadily. As a result, DeFi within the Ethereum ecosystem is no longer an experimental space. It has become a fully functional financial operating system, one that is increasingly understandable, efficient, and accessible. Against this backdrop, a clear internal structure of DeFi has emerged, consisting of several core verticals: decentralized exchanges, lending and borrowing, liquid staking, synthetic assets, asset management, and decentralized governance, DAOs. Below are the main DeFi directions, explaining how each works, what value it creates for users, and how together they form a unified financial system within Ethereum. Decentralized exchange, DEX. Decentralized exchanges introduced a new model of asset trading, enabling users to execute transactions without intermediaries. Within Ethereum, the key example is Uniswap. Unlike traditional exchanges, Uniswap does not use an order book. Instead, trading occurs through liquidity pools provided by users. Participants deposit asset pairs, such as ETH and USDC, and earn fees from trading activity. Prices are determined algorithmically based on the ratio of assets within the pool. Each transaction generates fees that are distributed among liquidity providers. This creates a built-in economic incentive to supply liquidity and ensures continuous market operation.
Lending and borrowing. Lending and borrowing platforms form the backbone of decentralized finance. These protocols allow users to supply assets as collateral or take out loans backed by crypto assets, with all processes automated via smart contracts. Aave is one of the leading protocols in this segment. Users can earn yield by depositing assets or take loans against collateral. If the value of collateral falls below a threshold, the system automatically liquidates the position. A special feature is flash loans, uncollateralized loans that must be repaid within a single transaction. They are widely used for arbitrage and advanced financial strategies. Liquid staking. After Ethereum's transition to proof of stake, users gained the ability to earn rewards by staking ETH. However, traditional staking locks up assets, making them inaccessible during the staking period. Liquid staking solves this limitation. It allows users to earn staking rewards while maintaining liquidity. The most prominent protocol in this category is Lido. Here's how it works. Users deposit ETH into Lido, which pools funds and delegates them to validators securing the Ethereum network. In return, users receive stETH, a token representing their staked ETH plus accumulated rewards. stETH remains liquid and can be freely used across the Ethereum ecosystem. It can be traded, used as collateral for loans, supplied to liquidity pools, or integrated into other DeFi protocols. In this way, staking becomes an active financial instrument rather than a passive one. Liquid staking demonstrates how Ethereum transforms core network functions into flexible financial tools, allowing users to secure the blockchain while maintaining full capital efficiency. Synthetic assets provide access to financial instruments that were previously available only in traditional markets. These are blockchain-based tokens that track the price of real or digital assets, such as the US dollar, gold, equities, or cryptocurrencies. Importantly, owning a synthetic asset does not mean owning the underlying asset. Instead, users gain price exposure. If the underlying asset rises or falls, the synthetic token reflects that movement. This enables trading derivatives, futures, and complex financial instruments without banks, brokers, or centralized exchanges. All operations are executed via smart contracts, making the system transparent and globally accessible. A key protocol in this segment is synthetics. It allows users to mint and trade synthetic assets known as synths. The system is collateralized. Users lock SNX tokens as collateral and mint assets such as SUSD or SETH. Prices are continuously updated via decentralized oracles, ensuring accurate tracking of real-world values. This enables seamless asset swapping without order books or direct asset transfers. In practice, users can shift exposure, for example, from Bitcoin to USD, in a single transaction without selling on an exchange. However, volatility risks remain, as sharp price movements can affect collateral ratios, requiring users to actively manage positions. Asset management. As the Ethereum ecosystem evolves, users interact with multiple protocols simultaneously. Assets may be stored in wallets, staked, lent, or deployed in liquidity pools and NFTs. Over time, it becomes difficult to maintain a clear overview of one's portfolio. Asset management platforms solve this problem by aggregating all holdings into a single interface. Tools like Zapper connect to users' wallets and automatically display all assets and positions across Ethereum. Users can view tokens, DeFi positions, staking rewards, liquidity pools, and NFTs in one place. This provides a holistic view of portfolio performance without manually navigating multiple platforms. Importantly, these tools do not custody or control funds. They simply read on-chain data and present it in an understandable format. Thus, asset management makes DeFi more accessible and user-friendly, turning a complex infrastructure into a practical decision-making tool for both beginners and advanced users.
DAOs, or decentralized autonomous organizations, are one of the core governance mechanisms within the Ethereum ecosystem. This model has become widely adopted and is now a standard for decentralized decision-making. The idea behind DAOs is that protocols and communities can evolve without centralized leadership, executives, or corporations making decisions on behalf of users. Within Ethereum, DAOs enable collective governance over protocol rules, financial parameters, and future development. Token holders can propose and vote on changes, including smart contract upgrades, fee adjustments, treasury allocation, and new feature launches. Voting is transparent, and outcomes are either automatically executed via smart contracts or enforced as binding decisions. Since all rules are encoded on-chain, the process does not rely on trust in individuals or organizations. As a result, DAOs make governance in the Ethereum ecosystem open and resilient. Decisions are made not by centralized entities, but by the collective community of users and developers. This allows protocols to evolve organically with the network while preserving decentralization and trust. Ethereum Stack, Gaming universe. The gaming vertical in the Ethereum ecosystem is one of the most dynamic areas in Web3, combining blockchain infrastructure, NFTs, and a decentralized digital economy. Built on Ethereum, the first large-scale play-to-earn, or P2E, projects such as Axie Infinity, Gods Unchained, and Decentraland introduced a new paradigm of digital ownership in gaming and laid the foundation for blockchain-based game economies. A major shift in the Ethereum gaming sector came with the practical adoption of Layer 2 scaling solutions, which absorbed most in-game operations that were previously too expensive or too slow on Layer 1. Platforms such as Immutable X, Arbitrum, and ZK Sync enabled high-frequency gaming activity to move off the main chain while still inheriting Ethereum's security and final settlement guarantees. For players, this means near-instant transactions when buying in-game items, upgrading characters, or participating in matches, without constantly worrying about gas fees. For developers, it enables the design of economies where frequent micro-actions are the norm rather than the exception. On these infrastructure layers, games began to evolve beyond simple NFT collectibles. NFTs became fully functional in-game assets rather than static items, while native tokens started serving as coordination tools between players, marketplaces, and external protocols. As a result, Ethereum gaming is no longer an experimental niche. As of 2025, it consistently attracts millions of active users monthly and generates significant economic value at the intersection of gaming worlds, NFT markets, and on-chain financial systems.
Games. Within the Ethereum ecosystem, blockchain games are evolving across several interconnected directions, each demonstrating how blockchain reshapes traditional game design and in-game economies. Blockchain-native games, such as Dark Forest, are built almost entirely on smart contracts. This allows not only automated game logic, but also full transparency of player actions and secure ownership of in-game assets. In this model, the game economy becomes autonomous. Players can trade, interact, and make decisions without centralized servers, while every event is permanently recorded on-chain. NFT-based games, such as Gods Unchained, emphasize digital ownership. Every card or item exists as a unique token that can be used in gameplay or freely traded and sold on external markets. This creates a strong sense of ownership, where asset value is secured directly by the blockchain, rather than confined to a single game environment. The play-to-earn segment, represented by projects such as Illuvium, demonstrates how gameplay itself can become a source of income. Players earn tokens and NFTs through participation, creating long-term engagement and forming self-sustaining on-chain economies. Together, these directions show that Ethereum is not just a platform for experimental gaming concepts, but a full-scale infrastructure for Web3 gaming, where interaction, economy, and ownership are enforced directly through blockchain logic.
Within the Ethereum ecosystem, metaverses represent a distinct layer where gaming mechanics, NFTs, decentralized governance, and on-chain economies converge. Standards such as ERC 721 and ERC 1155 enable the creation of unique or semi-fungible digital assets that users can collect, use in virtual environments, or trade externally. Integration with DeFi protocols allows assets to be used in financial operations, while DAOs enable collective governance over virtual worlds and their development. Projects such as Decentraland and the Sandbox illustrate how Ethereum serves as foundational infrastructure for ownership accounting, internal marketplaces, and digital communities. In this context, metaverses evolve from isolated game environments into autonomous digital economies that are deeply integrated with the broader Ethereum ecosystem. Game studios in the Ethereum ecosystem act as the core architects of digital worlds, translating blockchain capabilities into playable experiences and functional economies. They combine smart contracts, NFTs, and tokenized systems with traditional game design to build products capable of reaching mass audiences. These teams are responsible not only for technical implementation, but also for balancing gameplay and on-chain economics. Their decisions determine whether blockchain gaming remains a niche experiment or evolves into a mainstream entertainment category. Key players include Sky Mavis, the creators of Axie Infinity, who built the EVM-compatible Ronin sidechain; Immutable, the studio behind Gods Unchained and Guild of Guardians on Immutable X; and Animoca Brands, which operates both as a developer and a major investor in Web3 gaming. These studios collectively shape Ethereum's long-term integration into the global gaming industry, setting new standards for digital ownership and interaction in virtual environments.
SocialFi community. Within Ethereum's gaming ecosystem, SocialFi introduces a new model of digital interaction, where community participation, social relationships, and user contributions gain direct economic value. In this environment, not only physical assets, but also intangible ones, such as trust, reputation, and attention, become tokenized. Smart contracts automatically reward active participants with tokens or NFTs, while DAOs enable transparent collective decision-making. As a result, SocialFi transforms social engagement into a measurable economic resource that interacts with other ecosystem layers. This creates new incentives for community growth and strengthens the broader on-chain ecosystem. At the same time, the effectiveness of these models depends heavily on incentive design, user retention mechanics, and the ability to avoid speculative behavioral distortions.
Ethereum Stack, non-fungible tokens, NFTs. Within the Ethereum ecosystem, NFTs have become one of the core components that transformed an experimental concept into a fully developed multi-billion-dollar market. Digital ownership has gained real-world utility, and unique assets now benefit from reliable mechanisms for provenance and verifiable ownership. NFTs enable true ownership of one-of-a-kind digital assets, artworks, in-game characters, virtual land, music tracks, and collectibles. Unlike fungible cryptocurrencies, each NFT has its own identity and transaction history. Ethereum's smart contracts, powered by ERC-721 and ERC-1155 standards, ensure authenticity and secure transfer of ownership without intermediaries. As a result, Ethereum has evolved into the foundational layer of digital culture, where creativity, ownership, and economics converge within a decentralized system. Marketplace. NFT marketplaces in the Ethereum ecosystem function as infrastructure hubs for asset circulation, transforming abstract tokens into liquid, tradable assets. These platforms facilitate the exchange of digital art, collectibles, gaming assets, music, and Metaverse items. They establish price discovery, provide access to global audiences, and form the economic backbone of the NFT market. They can generally be divided into three categories. 1. General marketplaces. Support a wide range of NFT categories, OpenSea, Rarible. 2. Specialized platforms. Focus on digital art or niche segments such as gaming assets or virtual land, Foundation, SuperRare. 3. Aggregators. Combined listings from multiple marketplaces, enabling transparent price comparison and improved liquidity access. LooksRare.
NFT tools represent a suite of services and technical solutions that support creation, management, analytics, and secure interaction with NFTs. They form the application layer of the ecosystem, simplifying workflows for creators, developers, collectors, and investors. Their evolution directly impacts market maturity and the adoption of new digital ownership models. Core tool categories include 1. Minting services, Zora, Manifold. Enable NFT creation without requiring deep technical expertise, including smart contract deployment. 2. Analytics platforms, Nansen, Duna. Provide insights into market trends, user behavior, and risk assessment based on on-chain data. 3. Trading automation, Blur, Genie. Tools that allow users to react quickly to market movements, such as listings, partnerships, and price shifts. 4. Security services, Certicay, QuantStamp. Audit smart contracts and reduce exposure to fraudulent or vulnerable projects. Together, these tools make the NFT market more accessible, transparent, and manageable. At the same time, effective usage requires a clear understanding of their limitations, associated risks, and security assumptions.
Landing platform. Platforms such as NFTFi transform NFTs into financial assets by enabling users to take out loans using their tokens as collateral without needing to sell them. This increases liquidity and reinforces the practical utility of digital ownership within DeFi. Music platform. Music-focused NFT platforms such as Sound.xyz, Catalog, and Audius provide artists with direct monetization channels while giving collectors access to royalties, resale opportunities, and exclusive benefits such as gated content or private events. As of 2025, the NFT market within the Ethereum ecosystem continues to expand in terms of minting volume, even amid declining prices and reduced buyer activity. The total number of minted NFTs has surpassed 1.34 billion, approximately a 25% increase compared to 2024. At the same time, total sales volume has declined to $5.63 billion, with the average NFT price dropping to around $96. This trend indicates a market in a phase of high token supply and broad distribution, while pricing and trading activity remain below peak cycle levels. It highlights a key shift. NFTs are no longer just collectibles, but have evolved into mass digital assets. Their economic value is increasingly driven by scale, on-chain ownership, and integration with broader financial mechanisms across the Ethereum ecosystem.
Ethereum Stack, Real-World Assets, RWA. The market for tokenized real-world assets within the Ethereum ecosystem represents a new model of interaction between physical assets and the digital economy. Thanks to Ethereum's technological maturity, deep liquidity, and strong institutional trust, traditional assets such as bonds, credit instruments, real estate, and funds can be transformed into on-chain tokens that circulate freely within blockchain markets. Ethereum enables transparency, security, and automated ownership management through smart contracts. This allows both investors and financial institutions to retain control over real-world assets while simultaneously deploying them within decentralized financial systems. A key driver of Ethereum's dominance in this sector is its ability to convert on-chain liquidity into real purchasing power, creating a continuous inflow of capital into tokenized asset markets. Leading financial institutions, including JP Morgan, Goldman Sachs, Santander, Societe Generale, and BlackRock, have chosen Ethereum as the foundational infrastructure for their RWA initiatives. This validates its role as a bridge between traditional finance and decentralized systems, increasing liquidity for conventional assets and expanding access to global markets in a more open and programmable format.
Distributors. Distributors play a critical role in the tokenization of RWA. They enable the efficient issuance, distribution, and trading of tokenized assets among institutional and large-scale investors. It is distributors who bridge traditional finance with blockchain, enhance liquidity, and ensure regulatory compliance. It is worth highlighting Securitize, one of the early pioneers in building tokenization infrastructure for major players such as BlackRock and Apollo. As of 2025, it holds over $4 billion in tokenized assets. Other rapidly evolving platforms include Ondo Finance, Backed Finance, and MatrixDoc, all of which facilitate the efficient distribution of financial instruments within the RWA space. Tokenization platforms. Tokenization platforms create digital tokens that represent real-world assets, real estate, bonds, and debt instruments. They are responsible for the technical implementation of tokens, legal compliance, and asset management. If tokenization platforms create the assets, distributors ensure their accessibility to investors and organize the investment process. Together, they form an ecosystem in which the tokenized asset market operates efficiently and transparently. DeFi. Decentralized finance integrates RWA tokens into its native mechanics, allowing users to earn yield or use assets as collateral for lending. This creates a secondary market and significantly enhances liquidity. Key players in this segment include Ondo Finance, Centrifuge, Maple Finance, and Spock Protocol.
In the RWA space, trust and security are paramount. Custodians are licensed entities that safeguard tokenized assets in full compliance with regulatory and legal standards. Key players include Fireblocks, Anchorage Digital, and Coinbase Custody. Wallets are technological solutions, either mobile applications or hardware devices, used for storing digital assets. Their core value lies in giving users full control over their assets. Among institutional-grade solutions, MetaMask Institutional stands out by offering custodial APIs for institutions. Gnosis Safe provides multi-signature management for DAOs and funds, and Ledger Enterprise focuses on hardware-based key storage with maximum security. Data. RWA data services collect, aggregate, and structure information on tokenized assets, increasing both market transparency and efficiency. Within the Ethereum ecosystem, resources like RWA.xyz specialize in analytics and market trends. Global players such as Moody's and Morningstar contribute to risk assessment and help strengthen investor confidence. Platforms like Security Token Market provide liquidity, regulatory compliance, and transparency in the trading of tokenized securities. The pivotal role of Ethereum is driven by its combination of technological reliability, mature infrastructure, and a high level of trust from institutional participants. Regulatory compliance, smart contract,
Standardization and deep integration with DeFi make Ethereum the foundational layer for migrating traditional financial assets into the blockchain environment. The growth of RWA investment on this platform underscores not only its stability, but also its strategic importance in shaping the future architecture of decentralized finance. As of 2025, Ethereum maintains the dominant position in the real-world asset tokenization segment, accounting for approximately 81% of the global RWA market. In 2024 alone, the volume of tokenized assets surpassed $14.9 billion, reflecting nearly 60% year-over-year growth. With over 97,000 token holders and more than 205,000 unique addresses actively interacting with RWA, the ecosystem demonstrates both maturity and scale. Ethereum Stack, SocialFi. In the previous chapter on gaming, SocialFi was already mentioned as a tool for community building and user activity monetization. However, its role within the Ethereum ecosystem is far broader. This sector introduces a new layer of internet architecture, one where social connections, User-generated content and economic value belong not to platforms, but to the users themselves. This is not just a new category of applications. It represents a fundamental shift in how people interact in digital environments. SocialFi, as a distinct vertical, merges social networks with decentralized financial mechanisms, bringing familiar forms of communication and self-expression into the on-chain space. Within the Ethereum ecosystem, this segment is evolving rapidly thanks to mature smart contracts, robust infrastructure, and a large user base seeking control over their data, social interactions, and income streams. Here, reputation, community participation, and content creation are directly tied to economic incentives, while the rules of interaction are enforced in code rather than hidden within platform algorithms. The potential of SocialFi extends far beyond monetization or financial mechanisms. In combination with gaming and other Web3 platforms, it forms a new model of digital interaction where communication, reputation, community contribution, and ownership become fully fledged on-chain assets. Within Ethereum, this translates into environments that function as self-governing systems, where rules, value creation, and evolution are defined by the community rather than centralized intermediaries.
Creator economies. SocialFi is shaping a new economic model for content creators. Influencers, artists, musicians, educators, and researchers can now directly monetize their work and engage with their communities without intermediaries. This is enabled through social tokens based on the ERC20 standard, which can grant access to exclusive content, premium features, or governance participation. NFTs, in turn, represent unique digital assets sold directly to audiences. You are no longer just consuming content. You are becoming a stakeholder in it. The result is an interaction-driven economy, where value is co-created and rewards are distributed across all participants in the ecosystem. Within this vertical, several approaches have emerged. 1. General platforms, Farcaster, P00LS, enable content creation, community management, and the monetization of social activity. 2. Music platforms, Sound.xyz, allow artists to release music NFTs and engage directly with their audience, enabling fans to own shares of tracks and support creators directly. 3. Video platforms, LivePeer, provide decentralized infrastructure for video streaming monetization. 4. Educational environments, POAP, NFT certificate, offer access to knowledge and learning materials through tokenized participation and ownership. 5. Next-generation advertising models, Brave, BAT, projects that reward users for their attention and engagement, in contrast to traditional platforms where only content creators are compensated. Together, these approaches demonstrate how SocialFi within the Ethereum ecosystem is transforming social activity and content into on-chain resources with measurable economic value.
DeFi social networks. Decentralized social networks within the Ethereum ecosystem are redefining the foundation of online interaction. User data and social graphs are stored not on corporate servers, but on the blockchain. Users own their decentralized identity and social graph, which can be ported across multiple applications. This significantly reduces the risks of censorship and manipulation. A flagship example of this approach is Lens Protocol, which has become a foundational layer for many SocialFi applications within Ethereum. DAO communities. DAO communities are redefining the logic of social platform governance, transforming users from passive audiences into active co-owners.
In these models, governance token holders directly vote on key decisions related to moderation, budget allocation, and strategic development. Snapshot has become one of the core tools in this space, enabling DAOs and SocialFi projects to make decisions transparently and without centralized intermediaries, embedding the collective will of the community into on-chain processes. Gaming and Metaverse. The integration of SocialFi with gaming and metaverse environments is creating new socio-economic systems, where user interaction goes far beyond content consumption. In Ethereum-based games, players form DAO guilds, collectively own NFT assets, and make strategic decisions about the development of virtual worlds.
Reputation system. A critical component of SocialFi is reputation systems, which transform user activity into long-term on-chain trust capital. Actions on the blockchain shape a user's reputation, often recorded through soul-bound tokens, non-transferable assets that serve as proof of contribution, identity, and reliability. Ethereum Name Service provides user-friendly, unique on-chain identities, while Gitcoin Passport aggregates both on-chain and off-chain signals, helping mitigate Sybil attacks and build trust without centralized verification. Together, these mechanisms illustrate how SocialFi within the Ethereum ecosystem is establishing new rules for social coordination and digital identity. Overall, SocialFi within Ethereum reflects a fundamental shift in the logic of online interaction, where centralized platforms are gradually giving way to decentralized, community-governed environments. In this model, users own their digital identities, content, and the economic value they create, rather than handing it over to platforms. Ethereum serves as the technological foundation of this transformation, combining smart contract security, the flexibility of ERC20 and NFT standards, blockchain transparency, and scalability through Layer 2 solutions. A mature DeFi infrastructure and a global developer community are accelerating the adoption of SocialFi, turning users from targets of monetization into active participants in the digital economy. Ethereum Stack. Artificial intelligence. Within the Ethereum ecosystem, the artificial intelligence segment is evolving at a rapid pace, combining machine learning tools with decentralized architecture, transparent rules, and user sovereignty. Ethereum creates an environment where AI systems can operate without centralized control, with their logic and economic incentives embedded directly into smart contracts. This enables the development of models where access to data, computational outputs, and rewards for algorithmic performance are distributed openly, with a strong emphasis on security and privacy. This fundamentally distinguishes Ethereum's approach from traditional centralized AI platforms. AI marketplaces. AI marketplaces create an open environment where developers can publish, access, and monetize models and datasets without relying on centralized intermediaries. Smart contracts handle reward distribution, licensing, and intellectual property protection, making the AI services economy transparent and verifiable. A notable example of this approach is SingularityNet, which is building an open economy of AI agents and services within the Ethereum blockchain environment.
Machine learning algorithms are increasingly used to analyze on-chain data, simulate governance outcomes, and forecast the impact of strategic decisions, reducing DAO's reliance on manual processes. This enhances the efficiency and adaptability of decentralized governance, particularly in complex organizations with large participant bases. Projects like DAOstack are exploring how automated systems can augment collective decision-making without compromising decentralization. Artificial intelligence is also playing a growing role in DeFi analytics. By processing large volumes of on-chain data, AI can identify market patterns, assess risk,
and support more informed investment strategies. Platforms like Numeri demonstrate how the convergence of decentralized finance and machine learning can produce collective market prediction models, where data scientists worldwide compete and collaborate within a unified on-chain economy. A distinct dimension emerges at the intersection of AI and NFTs, where dynamic digital content evolves based on user actions or external conditions. Programmable NFTs, as seen in projects like Async Art, transform digital art into living systems, capable of real-time evolution and far beyond static digital objects. In summary, artificial intelligence within the Ethereum ecosystem is not merely a set of tools. It serves as a foundational layer for building decentralized, autonomous, and adaptive systems. The convergence of blockchain and AI is shaping a new digital infrastructure, where algorithms operate transparently, economic incentives are encoded directly into protocols, and both control and value creation remain in the hands of the community.
Ethereum Stack, stablecoins. Within the Ethereum ecosystem, stablecoins have become a foundational layer of the digital economy. Their core function is to reduce volatility by providing assets with a fixed value, most commonly pegged to the US dollar. Because of this, they have evolved into a universal medium of exchange across DeFi, real-world asset tokenization, DAO governance, payment systems, gaming, and SocialFi. Within Ethereum, several stablecoin models have emerged. They differ in their collateral structures and mechanisms for maintaining price stability, which directly influences their level of decentralization and resilience. Centralized. Fiat-backed stablecoins issued by companies holding bank reserves. This category includes USDC by Circle, known for its regulatory compliance focus, USDT by Tether, the most liquid stablecoin globally, and PYUSD by PayPal, which bridges traditional finance with blockchain infrastructure. Decentralized. Crypto-collateralized stablecoins with no centralized issuer. The most widely used examples include DAI, MakerDAO, GHO, Aave, and Rai, Reflexer.
Algorithmic models in which stability is maintained through automated supply adjustments. Notable examples include Frax, which uses a hybrid architecture, and SUSD from Synthetics. In DeFi, stablecoins serve as the primary source of liquidity. They form trading pairs on decentralized exchanges, are widely used in lending protocols, and underpin yield-generating strategies. In the RWA segment, they function as the settlement and store of value layer for tokenized bonds, funds, and credit instruments. For DAOs, stablecoins act as the financial backbone of treasuries, enabling predictable budgeting and funding of initiatives without exposure to market volatility. In gaming, Web3, and SocialFi applications, they power microtransactions, in-app purchases, and creator-community economic interactions. The stablecoin infrastructure on Ethereum is rapidly scaling through Layer 2 solutions and cross-chain protocols, reducing transaction fees and increasing settlement speed. At the same time, tools for risk management and automated hedging strategies continue to evolve. As of early 2025, Ethereum remains the leading network for stablecoins. Approximately $67 billion in USDT and $35 billion in USDC are circulating on the network. Monthly transaction volumes exceed $800 to $850 billion, with more than 600,000 active addresses per day. Annual turnover grew from $1.9 trillion in February 2024 to $4.1 trillion in February 2025. In conclusion, stablecoins on Ethereum represent far more than a digital representation of the US dollar. They form the core financial layer of Web3, bridging traditional financial systems with decentralized economic infrastructure. Thanks to them,
blockchain has moved beyond an experimental environment and has become a fully functional settlement layer for payments, value storage, and the development of new financial services. Stablecoins provide predictability in a volatile environment, enhance market liquidity, and simplify interactions between users, protocols, and institutional participants. They act as a universal bridge between fiat economies and digital assets, lowering entry barriers and accelerating global capital flows. Ultimately, stablecoins make blockchain-based payments not only possible, but truly scalable, efficient, and suitable for everyday use, laying the groundwork for a new financial system that operates without borders, intermediaries, or time constraints.
Key takeaways from the chapter. 1. Layer of blockchain project development. The first and most important step is understanding which infrastructure layer a project is built on within Ethereum or any other network. This determines its architecture, strategic direction, scalability potential, and readiness for integration with real-world businesses and the traditional economy. 2. Functional categories of projects. Qualitative evaluation begins with identifying the functional role of a project. For ecosystem-native solutions, this helps determine their systemic importance within the network. For independent or multi-ecosystem projects, the key focus shifts to market demand, integration potential, category scale, and long-term relevance within the Web3 landscape. 3. Ecosystem scale and structure. The next step is assessing the ecosystem in which a project operates. The presence of infrastructure layers, DeFi protocols, stablecoins, wallets, RWA services, oracles, and bridges help define its specialization, technological maturity, scalability, and attractiveness for both developers and institutional participants. A well-developed ecosystem significantly increases the likelihood of long-term project sustainability. 4. Ecosystem context and positioning. Analyzing a single ecosystem also serves as a foundation for broader cross-ecosystem comparison. It allows for the evaluation of strategic relevance, innovation capacity, and the ability to support key market narratives, such as DeFi, RWA, AI, SocialFi, and digital identity, while continuously adapting to shifts in the global Web3 landscape.